Welcome to the Buffered ETF, guys. Bear markets happen, but so do bull markets, so why not be prepared for both? Buffered funds offer some downside protection and some upside growth potential. They're like ETFs with airbags so that you can get retired, stay retired, and stop stressing over the next market crash. All content is for information purposes only and should not be relied upon as individual advice. Investing always involves risk and possible loss of capital. All opinions expressed herein are solely the opinions of the person making them. Participants and clients of ATX Financial Planning and guests of this podcast may maintain positions in the securities discussed in this podcast. Talk to your advisor before acting on anything. Nothing mentioned on this podcast, including specific investments mentioned, should be taken as a recommendation. Advisory services are offered through ATX Financial Planning, LLC, an SEC-registered investment advisor. All right, welcome back to the next podcast episode of the Buffered ETF, guys. We have myself, Mike, and we got Dallan next to me here, and we've got Jack Nussbaum with Innovator ETFs. And welcome. Glad to have you. Tell us a little bit about yourself and about your company, Jack.
Yeah, well, Dallan, Mike, it's always good to see you too. Thanks for having me on. I work with Innovator ETFs. We are, a pioneer of the defined outcome ETF space. So we're based out in a small little town, a suburb of Chicago, about 20 miles due west, called Wheaton, Illinois. So we started back in 2000, and our two founders started a different ETF shop that was also local to the Wheaton area in the early 2000s called PowerShares. So Innovator kind of has a legacy stemmed from our two co-founders within the ETF community. And, after they sold their old practice to Invesco, who was trying to build out their ETF leg, they started Innovator back in 2017. And so about 8 years later, we're still kind of trying to pioneer the defined outcome or buffer ETF. There's a lot of different names for the space.
Yeah.
But yeah.
You'll have a lot of trademarks and a lot of names like that.
We really do. Defined outcome, accelerated return, defined income. Yeah, there's a lot of different we wear a lot of different hats here at Innovator. So we have defined outcomes, the umbrella term, but there's a lot of subsets now. So it's great.
Yeah, I can remember when you first launched, you had the first one that was like on a quarterly basis, you'd roll them out, and then on a monthly. Now
that was back when we had like 12 to 30 tickers, and now so there's a lot.
Yeah. So what are you up to now? I mean, that's a lot to keep track of.
Yeah. So it's the nice thing is, since I joined, we hadn't really listed any defined outcome ETFs yet. So I've been able to, learn the space as we've grown. So like you mentioned, Dallan, you're right. When we first started, it was just, hey, here's an ETF tied to the return of the S&P 500, and you have downside protection over a year. And that was really simple. And we had them available every quarter. And then we shifted to making them available every single month with different protection levels. And then we introduced other reference assets you can track, like the QQQ or EFA, emerging markets. And then before you know it, now we're north of about 150 different tickers, a lot of different strategies that are trying to accomplish different things within the portfolios of groups like you all.
So that's awesome. So not only have you all grown, but that this whole space has grown. Can you kind of comment on, give people kind of some perspective of how this has grown as an industry or as an offering?
Yeah, for sure. So when we started in 2018, we were first to market. Option-based ETFs in general were very few and far in between. Now about 8 years in, we're managing just north of 25, just around 26 billion in assets. And the space has ballooned itself as well, and is about 50 billion in assets across the whole suite, give or take a little bit.
So y'all have give or take half of that market share.
Yes.
That's a big number.
That's kind of great of, the benefit of being pioneers in the space and first to market is as this space grows, and we'll talk about some other solutions we have, we're always bringing out new ideas to the marketplaces for advisors. And, people look to that and they like to work with the pioneers and the experts of the space. So, it's grown tremendously. I think BlackRock put out an article a couple months back expecting the space to grow nearing about 650 billion in the next 5 years. And that includes, a whole plethora of option-based ETFs. It's not solely defined outcome, but a very heavy component of the ETF growth in the option-based side of things is defined outcome ETFs. And ETF listings in general in the last 5 years have skyrocketed. And that's because there's so many that are now tied to specific outcome periods. Instead of just an evergreen fund that rolls forever, the defined outcome suite, they're perpetual, they reset year over year, but they're tied to a specific outcome period like July to July. And that's why it's always important for folks that, they consult a financial advisor to make sure they're navigating these solutions.
Something just hit me that there's quite a few companies in this space, but not like dozens and dozens. But y'all have, I think you said, roughly half the market share right now, and you're competing against some huge names. Invesco has funds in this space. BlackRock has funds in this space. Goldman Sachs has funds in this space. Right. Congratulations. That's an amazing achievement.
Yeah. And I think it's important to, just because a group comes in with a name brand behind it doesn't automatically guarantee results as far as getting traction. And I think you two have learned and have been at the forefront of this industry that, there's a pretty steep educational curve with using these types of solutions. And so we very much pride ourselves of not only bringing out new ideas into the marketplace here at Innovator, but also being consultants and making sure that it is properly communicated. This is what this ETF is designed to achieve. This is the upside cap. This is your downside buffer that's built in. This is the outcome period. This is where you might use it in a portfolio. There's a lot of different variables within this space. And so, as new people come in, it's a big commitment. I didn't think I even mentioned it. We have over 150 tickers here at Innovator. And so a new company that's trying to get into this space, that's a big undertaking to kind of come in and try to compete with that more or less. And so again, that's kind of the benefit of being first to market. But the bigger the names, like you said, Mike, a BlackRock, Allianz, Prudential, some of these firms that, are going to be much more commonplace for your traditional, mom and pop, there's just a lot of legwork that goes into it. And it's just validation more than anything else. Is those bigger companies come into this space, they are seeing the growth it's experienced so far. They're seeing the trajectory, and they want to be able to offer their clients something similar too. So it's it's been, enjoyable to learn the products as I've gone throughout the years. It's been enjoyable to work with groups similar to you all. And we're just starting to scratch the surface really with what these products can offer. Yeah.
And Dallan and I are constantly evaluating our portfolios and figuring out which one is going to be a fit where, and we'll have conversations with you almost constantly like, hey, here's this new one from your firm, or here's this new one from another firm. Let's talk about the pros and cons, where it may fit, where it may not, where it may or may not make sense. Can we see any back testing on it? All of those types of deals. And sometimes they play out over time, and markets change and emotions change and where they may fit in. So it's nice to have a lot of choices.
Yeah. And that's, we're big advocates of the space. Like we understand that, while Innovator, we like to claim, hey, we're a one-stop shop. There's different flavors. There's different nuances on these types of products. And we really think they can be powerful tools to help advisors and their clients navigate the uncertainty of the markets, right? It gives your clients a level of peace of mind to know, hey, I've worked hard throughout my career, and maybe I'm at or nearing retirement, and I just don't want to mess it up, right? So what's out there for me? And that was ultimately kind of what our CIO went through after he sold their original ETF business to Invesco, and his advisor put in front of him an annuity that kind of has similar payoffs to what we do in our buffer ETFs. And that's what ultimately kind of sold him back in 2007. This is what I'm being offered. I like knowing I have some upside room to grow. I also like knowing I got some protection on the downside in case things go south. And that was kind of how, it started clicking in his head of, well, maybe we could offer this in an ETF wrapper instead of having to go through an insurance provider or a bank to get a product that typically has high minimums, credit risks. They're not as tax efficient. So our whole thesis at Innovators, we're trying to deliver defined outcomes via the ETF wrapper, which just grows exponentially year over year still because of the benefits it carries: low costs, tax efficiency, all that good stuff.
So I have a question. So I'm sure there's a lot of advisors out there at first blush. You call on, you meet, you email, whatever, and it's new. They're like, hey, call me when it's been out for a while. I don't get it. It doesn't fit into my black box. It's not a pure equity. It's not a fixed income play. Don't know what it is. Don't have time to figure it out. Some of those guys eventually come around and will change their minds. Probably, I can't think back because I've been using these for many, many years now. I can't remember where I started on it, but it wouldn't surprise me. I guess you'd probably have two initial reactions. Either this is really cool, I want to dive in and see if it's a fit, or no thanks, but maybe they like it over time. What have you seen from advisors who maybe kind of give you the Heisman at first, who maybe come around to this some of these concepts? What are you seeing in a shift in their mindset?
Yeah, there's a lot of different reasons why people can come around on this type of space. Some of it is as simple as when they hear about it, markets maybe at nearing all-time highs and things are going well, and they don't have any desire to add a layer of protection because the market's returned 20+% in the last 12 months, right? But then a lot of times you start to hear, people kick the interest a little bit more into gear when the markets drop 20%, So, I mean, for us, for our growth at Innovator, there's periods of time. If you think about Q4 2018, Christmas Eve was the low that year. COVID, peak to trough, 35% drawdown. 2022, equities return, were down 18, core bonds were down 13. During those periods, you tend to see a lot of people like, all right, let me kick the tires on these and chances are a lot of them are hearing it from their own clients, for people that usually the big pushback sometimes with buffers or defined outcome strategies is, well, you know what? I don't want to cap out my upside. And for certain types of clients, if they are conditioned to understand that they have portfolios have a beta of 1, if market goes up 10, they're going up 10. If the market goes down 30, they're going to be down 30. If they're okay with that, then that's why these buffers aren't always a one-stop or one size fits all. But for a lot of folks that are at or nearing retirement, they've spent years accumulating this wealth. They are far more concerned with not losing on the downside than they are with making outsized returns on the upside. They are willing to sacrifice growth above this cap that we offer on these defined outcome ETFs in order to get that downside protection built in. So, that's kind of the story on the equity side. And then we'll talk about it a little bit later too. But a lot of groups haven't even considered using these as a bond or a fixed income complement because they don't kick off income, but they got the protection. They give you a little bit higher degree of potential tax deferred growth. And so once that kind of clicks for a lot of people, they'll start at least being like, you know what, let's take a look. And every group I work with utilizes these funds in different ways. They are not a one-stop, one size fits all solution. This buffer level is designed to be used here, whereas this buffer level, more conservative, might be used as a replacement for cash or bonds. And so, it's just, we like to just work alongside groups here, kind of what their risk management process is, anything they're struggling with, and see if we're able to help present an alternative.
And even with an advisor's book of business or just someone who's doing this on their own, it could fit in different places. You've got one person who may be FOMO, fear of missing out. They want to get all the upside. And then you've got another person who thinks they're FOMO, but then when the market goes down, they suddenly change their tactics, or maybe they've gotten near or to retirement before they were aggressive. It can handle all the downside, but then they get to retirement and they're like, I don't want all that downside anymore. I didn't realize it until this last, kick in the pants. And now I'm starting to feel it. And then you have more conservative portfolios. So each person's different and unique, right? And that's one of the beautiful things about what you offer and just the whole space and advisors. We can look at everybody uniquely and say, here's where we think we may be able to do something. And each person, each portfolio is a little bit different. And I'll ask you a couple more questions, and then we'll probably go save our next concept for the next podcast. But let's talk about some of the key benefits, if you will, of the buffered space. And before we do that, I'll just kind of open up and say that we don't make any recommendations on this podcast. Nothing we say is a recommendation for or against. We're trying to learn. We're trying to educate. We're trying to go through investing together. While we do have some funds invested in Innovator Funds ETFs, we are not affiliated with them. We're not endorsed by them. They don't endorse us. We don't endorse them. Just a company out there who offers products and services in the space. Great resource to have on the podcast here. And most of what we talk about will be gross of fees unless we state otherwise. And that just means gross of any fund fees, ETF fees, and advisory fees, etc. So let's talk about some of the things low cost. So in your materials, and I've heard you say over the years, low cost. Tell us a little bit about what that means for Innovator ETFs.
Yeah, definitely. So when we think about just like buffered products in general, the ETF didn't come around till 2018, but you've been able to get these payoffs through other wrappers for decades. And most of them are issued by banks. So when we talk about like a structured note, that's a product issued by a bank that's tied to their balance sheet that can offer, upside of the market. There's a lot of different nuances, but what we're offering at Innovator is very similar to those. Or you could go through the insurance provider route and get something via an annuity wrapper. Fees on those products have come down over the years, but typically you have a high minimum investment for clients to be able to even get access to those types of payoffs. And then a lot of times there's fees, and sometimes they're not very transparent. They might be 2 or 3%. Sometimes the advisor gets a different sales charge on top of that. There's fees to sell out early. There might be fees along the reset point every single year. So there's just a lot of embedded fees, and that ultimately can eat away at returns for their clients. And so via the ETF wrapper, an ETF charges an expense ratio, which is, the amount of percentage of the amount invested, and that's deducted every single day from the share price or the net asset value of the ETF. And so here at Innovator, our expense ratios range anywhere from 69 basis points to the year to 80, 89 basis points, 85 basis points if you like some international exposures. Our average expense ratio is right around 79. That's kind of where the meat and potatoes of our lineup is, the 1-year terms. But 79 basis points, 0.79%, that's the only fee you're ever going to see with these ETFs. So it's very transparent, a lot cheaper than other types of exposures. And if you're familiar, or if the people listening are familiar in the ETF industry, ETFs tout low fees in general. You can buy an ETF that tracks the S&P 500 for as low as 2 basis points.
Mm-hmm.
So when you compare buffer ETFs or defined outcome to the ETF community overall, they're certainly on a little bit of the higher end of the spectrum. And back to your earlier point, Mike, there are some investment advisors that hear 79 basis points and they might say, we just keep it low fee. But for what these are designed to do, this is insurance for the portfolio. People buy insurance for everything else in their life, home, car, whatever. And it's to have protection in place before the fire hits. And that's where, a low cost ETF, market's down 20%, you're going to be down 20%. Here's something that gives you a little bit of peace of mind. So 79 basis points, that's the expense ratio of our flagship buffer ETFs. And that's the very transparent. And you only hold half the outcome period. You don't pay that whole fee up front. It's deducted every single day, so you'd only pay half the fee or based off of your holding period.
Good to know.
And to kind of summarize that in the cost. So low cost, it comes to me and really and I love how you said, hey, that you can get some ETFs out there for a couple of basis points, like next to nothing, almost, couple basis points. But low cost relative to, one, some mutual funds still considerably more than that. And two, because of the potential value that can be embedded in here with the kind of insurance hedge type portion using options and caps and downside protection on some of that, et cetera, right? If someone was to go out and create that own strategy on their own, there's a good chance they would be considerably higher that in fees, right? Because you've got these economies of scale that you get to bring together, these incredible and smart managers and software and systems, and be able to bring all these options and make it easy and accessible to buy and to sell. That is where the low cost proposition comes in, right?
Yeah, you're exactly right. And I think, you could go replicate what we're doing through the use of options. It's going to be very time consuming. It's not going to be as tax efficient. You're right. As far as economies of scale, you're not going to get as good pricing. And so, there's a lot of growth in this space, specifically in like the hedge fund or, the endowment community. UConn just started using these defined outcome ETFs instead of traditional alternatives because they kind of come in like, we could run an option overlay that's similar to this, but it's going to add a lot of complexity and there's going to be a lot of trading. And to be able to offer this in a turnkey solution that just trades on the exchange, that's liquid every single day, and for 79 basis points, that's exactly what we're looking for versus, and knowing, hey, these are our outcome potentials instead of relying on, a long short fund to hopefully work out when you need it to or anything like that. So it's just, it's the most efficient way to get this type of exposure at the moment.
Let's parlay that and go on to tax efficiency, right? So part of this is that, of course, if you're in a tax deferred account like an IRA, you can invest in just about anything and get tax efficiency along the way. But in the non-qualified, call it the brokerage account that people may know, the non-IRAs, a lot of the time, even if you own a fund and hold it, a lot of the time there's this high turnover inside of certain mutual funds. And so you're getting tagged on this, even though you're holding it, you're getting tagged oftentimes annually on these taxes. So how are these different?
Yep. So the big key is that we're doing this in the ETF wrapper and not a mutual fund wrapper. So ETFs are open-ended. We can create more and redeem shares as demand dictates one way or another. But the big benefit of the ETF and why it is so tax efficient, and this is ultimately the reason outside of low fees why ETFs continue to grow is this tax efficiency, is utilizing what's referred to as the in-kind transaction. And so if you look at an ETF tracks an index like the S&P 500, and if in that index, say Microsoft somehow leaves the index and Tesla enters, instead of it being a sell of Microsoft and a buy of Tesla, which historically had triggered a taxable event, what an ETF can utilize is this in-kind transaction that actually just swaps those two stocks out. So it's an exchange instead of a buy and a sell, and that is not a taxable event. And that's very important. And what kind of the growth of the defined outcome ETF space, since we're using options that track the S&P, we're not owning the individual stocks themselves. Back in 2019, we worked with the SEC and SIBO to help create a rule that allows us to in-kind out option positions instead of just in-kind out the individual stocks. And so every other provider that's come in since has been able to utilize that rule, and that's important. Yeah, exactly. And that's important with these because at the end of every term or period, when our ETFs reset, under the hood, we give you a new cap and buffer for the next year, but that is not a taxable event because of that in-kinding process, a few other reasons. But in the case of our defined outcome ETFs, these are tax deferred until you sell. You could hold these things and, for 15, 20 years, every year, you're kind of locking in your gain with a new buffer, resetting a new cap, but you never get taxed on anything until you sell. And then, which at that point, it'd be treated as a capital gain. And if you hold it over a year, if you're looking at non-qualified money, you'd be looking at a long-term capital gain rate if you held it under your short-term. But so at the end of the day, these are treated from a tax standpoint like any other ETF or individual stock. It's going to be based off of your holding period. There's just segments along the way that we have a cap and buffer for a year, but that doesn't affect the taxable scenarios at all.
That's beautiful. And so even if you took the most brilliant guys in the world, let's say us three, probably not, but you took the most brilliant guys and they could go out and run these option strategies, but they were just doing that on their own for their own portfolio, you wouldn't have this ETF layer. So you'd have taxation when you do this stuff, right? So we already talked about the cost of doing that without the economies of scale, et cetera. But then you've got the fact that you don't get this tax efficiency because it would not be inside of the ETF wrapper. So really, for me, those two, the low cost and the tax efficiency, go hand in hand big time.
Yeah, you're exactly right. Yep. Tag on that with credit risk, and it's a no-brainer for a lot of groups.
So then you also mentioned credit risk. That there's less of a credit risk going this route. Can you kind of give our audience just an overview of what that means?
Yeah. So for, again, backpedaling, if you own an insurance product, or if you go out to JP Morgan, you buy a structured note issued by JP Morgan, you're giving your money over to them, and you're tying your returns to the balance sheet of that institution. And we're not here to say JP Morgan's going anywhere, right? But you are under the event that if they do default, there's a hierarchy of what gets paid out based off of their balance sheet. And so part of owning an ETF, and this is not unique to Innovator, this is actually part of owning any ETF, is the owner of that ETF actually owns those underlying securities. If you buy SPY, you own those 500 stocks that make up the S&P 500. There's just a fund provider that wraps them up for you. And so the same thing holds true with defined outcome ETFs. Innovator's just the fund provider. We have a sub-advisor, Milliman Financial Risk Management. They do all of our option trading, but we're just wrapping up the options in this ETF wrapper and then delivering them, and your clients you can buy on the exchange. But the big caveat is that you're not tying your money back to Innovator. If Innovator were to go default, that does not change the value of the underlying options at any point. And so not having that credit risk because a lot of people coming off the heels in 2008 when Lehman Brothers went down, if they had structured notes issued by Lehman, they were left with pennies on the dollar on that investment. And so being able to remove that uncertainty out of the equation, any option is backed by the OCC, the Option Clearing Corporation. And they have never defaulted on an options obligation since that group was incepted in the 1970s. So you got a ton of layer of added behind the scenes defense on these, which is important.
I think that's good. So you're kind of mentioning the structured note, or maybe you have a JP Morgan or a ABC Bank or a Wells Fargo or a XYZ Bank where it's backed by some type of claims payer, right, to bank, et cetera, or maybe in the annuity space. Not all annuities are alike, but certain annuities are on the general account as opposed to a separate account. The general account would be backed by the claims paying ability of that company. to simplify things. And you're saying that this is not backed by whether your company stays in business or anything.
Correct.
The one question that we have had, and we've even talked internally about it several times, and I'll preface it by saying that the options, the flex options, the bonds, if any used, or the zero coupon bonds, a lot of the buffered companies will kind of bake the cake with a little bit different ingredients. Sometimes they're similar ingredients, sometimes they're different. Would you agree with that?
Yeah. There's a lot of different ways. A lot of different ways you can have the option strike set up to deliver a defined outcome. But yeah, you're right.
And then the credit risk and the options provider, right? So if you're not subject to the claims paying ability of Innovator ETF, what does it look like from the options facility? Like what happens if that options market just goes nuts? Or what's the risk there? Because there's always a risk with everything. So we want to think,
there's always a risk.
Just understand this a little bit better.
Yeah, it's a good question. The nice thing is we haven't had to test it. So that group, the OCC, the Option Clearing Corporation, they were brought around in the 1970s to basically be the backstop if anything goes wrong in the option market. And so since that group, like I said, was incepted, they haven't had to. So we're talking about some severe periods of distress where the option market's still handled as expected. But the OCC is what's deemed a SIMFU, which basically just stands for systematically important financial utility, or in other words, too important to fail, backed by the federal government, right? Yeah. So if the OCC was not ever unable to step in and provide liquid markets in this space, that's where the federal backing would kind of help out. So the next question we got to ask ourselves is, well, what would it take for the government not to be able to back it? And that's something where I'll probably run down to Texas and we can grab our shotguns and go to the shelter. Catastrophic meltdown of the economy or something like that. So that's kind of the long-winded answer. Our sub-advisor always likes to, it's obviously a pretty dramatic example, but it would be something to the point of, hey, your investments are the least of your worries because the whole U.S. economy is crumbling.
Right. Excellent. Well, I think that is a great ending point for this podcast. And I hope y'all will join us for the next podcast. We're going to talk about dual directional buffered ETFs. Big mouthful. So check out the next podcast and we'll pick up there. Y'all have an incredible and a blessed day.
Take care, everybody.
We hope you enjoyed this episode of the Buffered ETF Guys. Please hit that subscribe button so you never miss an episode and share this podcast with someone who could benefit from it. Check out our blogs, webinars, and other resources at atxfinancialplanning.com. You can easily book a meeting with an advisor at ATX Financial Planning at atxfinancialplanning.com. That's atxfinancialplanning.com. We're headquartered in Austin, but we serve clients from coast to coast. Be on the lookout for our next episode. Stay wealthy by protecting your wealth. All content is for information purposes only and should not be relied upon as individual advice. Investing always involves risk and possible loss of capital. All opinions expressed herein are solely the opinions of the person making them. Participants and clients of ATX Financial Planning and guests of this podcast may maintain positions in the securities discussed in this podcast. Talk to your advisor before acting on anything. Nothing mentioned on this podcast, including specific investments mentioned, should be taken as a recommendation. Advisory services are offered through ATX Financial Planning, LLC, an SEC-registered investment advisor.